Yeah, so you're entrepreneurial, you're brokering deals, you're also trying to create deals and do deals yourself, and then you figure out an inefficiency, which was you starting out in founding Needle. But before we get into Needle and the mechanics and all the details, talk to us about a little bit about commercial real estate. Obviously, you still keep a close eye in the space. You got your finger on the
Yeah.
pulse. What are you seeing currently where we are, especially you being having been in the space for long enough, kind of post GFC now through COVID and interest rates being dropped to near zero and all the capital flooded into the space and some syndicators finding themselves with their swim shorts, below their knees after the
Yeah.
tide went out and putting bridge debt, which is historically not meant for value add deals. Bridge debt is meant for a deal that's in distress and you're trying to bring it really to stabilization as opposed to just bridge the gap. And that's hence the name is on it. But syndicators just got used to putting bridge debt, high octane debt to financially engineered deals. And I talked to somebody senior or was listening to a podcast. I'm not sure if it was a direct talk, but they said that bridge debt is perfect. It'll always work except when it doesn't. And when it doesn't,
Yeah.
you lose it
You
all.
lose it all.
So we've seen that with a lot of firms, some Canadian firms also that were heavily involved in Arizona, and they lost close to $300 million in LP equity, totally wiped out, and it was all over the news. So not only them, even Blackstone had to give the keys back for some deals in, I believe, an office deal in Las Vegas. But overall, currently today, where are you seeing the where do you think the market is? If the particularly multifamily market, if it was a clock, the market cycle was a clock, and 12 o'clock is top of the market, the best time, and 6 o'clock is the bottom of the market, the absolute bottom. What time is it today? Do you feel?
I guess probably 9 o'clock, I'd say, because we're not fully out of the woods. I think that there's still some opportunities to be cleared out of the market. Some deals that have yet to go bad or go back. The Midwest, as opposed to, so when I think in 2015 is when I first went to NMHC, and everybody was like, yeah, we want the smile of the US. So from the West Coast down through the Southwest, Gulf states, and up the East Coast, including Florida. And nobody really wanted to talk about the Midwest. But fast forward to 2020, I think everybody, or maybe it was 21, everybody wanted to come and evaluate opportunities in the Midwest, Cincinnati in particular, because we have very strong rental fundamentals. We have a chronic lack of housing for various reasons, in this market in particular. And it's always submarket to submarket variable, but they wanted to come to the Midwest because it was good, strong, stable fundamentals. Whereas, some deals in Charlotte or Phoenix had not panned out the way that they thought it would for various reasons. One, I think, in markets like Phoenix and Houston, and I think even Dallas a little bit, like it's so easy to build multifamily there. So you have this chronic oversupply, I'll say. So you always have more product coming online. You're always seeing properties running specials and concessions and 1 month free or something like that. And we saw it even in downtown Columbus. Like there was a boom of building in downtown Columbus, and that's a very soft submarket of a very strong overall market. 2 months free at one point, rental rates staying steady, if not slightly declining. And Columbus is one of the strongest markets in the Midwest. It's probably of the kind of I'll say excluding Chicago, but like of this part of the Midwest where I'm in, it's a very strong, very desirable market. So
It's slow and steady. It's a slow and steady market, I've heard, right? You're not going to have that boom of a 20%
yeah,
rent growth, but you're also not going to have the big dips as well because of
that's right.
hypersupply and other issues.
Yeah. It's a good
How,
diversification to your portfolio.
yeah. How about as far as obviously the Fed is meeting this week, I believe, to on the next their next meeting. for the rates, and the markets have a 95% or even more that the Fed will decrease rates. Is that what your belief is?
Yeah, I mean, if I had a crystal ball, I would be in a different chair. But yeah, I think so. I mean, so back to the my days in brokerage, like we went, so when you guys started in 2020, there was like a pause on the market from like February to about June. Like nothing was happening. And then all of a sudden it was like, oh, things are going to be great. And and that was because of the COVID stimulus checks coming in. And what you saw happen was that all the tenants were catching up on back rent. Plus they were out buying TVs and other knickknacks and things like that. And so the fundamentals of rental properties went through the roof because not only were collections being caught up on, but rents were increasing significantly over time.
You also had the
Um,
interstate migration too, people moving to those more Texas and Floridas to run away from
yeah, remote
draconian
work
laws. Yeah.
it was the thing to do. And then they dropped rates. And then fast forward like year and a half or so, they raised rates real quick and it basically shut the faucet off
Yeah,
on,
11 consecutive times, and there was a pause or
yeah,
Yeah.
two, and then two more times, and which has brought us close to where we are today.
it was very aggressive. And, from a deal maker perspective, it was terrible. For the overall economy, hard to say. I don't, I think that they probably raised them too quickly, too fast, and kept them too high for too long. But that's what happens when you inject trillions of dollars into the economy. So just don't do
Inflation
that. How about
hit
that?
like inflation hit like 40-year highs at that point.
Yeah.
9%,
Yeah.
Yeah.
borderline.
So they
hyper.
panicked and the only lever they had was to increase the rates, right?
A lot of experts say they did it a little too late. They should have started increasing
Yeah.
rates a little sooner.